You've probably heard the term standard deviation thrown around, right? Maybe in a math class or something. But what if I told you that a simple twist on this idea is something professional traders on Wall Street use to get a read on the market's mood and build some really complex strategies? Well, let's break down how this powerful concept called dispersion actually works. So here's what we're going to cover. We'll kick things off with the basics of standard deviation. Then we'll see how it morphs into this market-wide concept called cross-sectional dispersion. After that, we'll dive into why it's such a big deal for stock pickers, how traders actually try to bet on it, and finally, we'll uncover the huge hidden risk that comes along for the ride. All right, so let's start at the very beginning. Standard deviation might sound a little technical, but honestly, it's just a way to measure how spread out a bunch of numbers are. Think of it like this. If you have a low standard deviation, it means all your data points are kind of huddled together, really close to the average. But a high standard deviation, that means they're scattered all over the place, far away from the average. It's really just a measure of consistency, or, a lack of it. Here's a fantastic real-world example to make it click. Imagine two cities, right? Both have the exact same average high temperature of 20 degrees Celsius. But the coastal city is pretty mild all year round. That's a low standard deviation. The inland city, on the other hand, has these blazing hot summers and freezing cold winters, a really high standard deviation. Same average, but a completely different climate. And this classic bell curve gives us a great visual for this. See, a tight, tall curve means low deviation. Most of the results are clustered right there in the middle. But a wide, flat curve, that shows high deviation. The outcomes are spread all over the map. For a trader, understanding the shape of this curve is just fundamental to understanding risk. Now, you might also hear the term variance. Just think of it as standard deviation's older sibling. In fact, standard deviation is just the square root of variance. So why bother with the extra step? It's simple, really. Standard deviation brings the number back into a unit we can actually understand, like dollars for a stock price. It's way more intuitive, whereas variance gives you a number in dollars squared, which is, well, it's pretty hard to wrap your head around. Okay, so let's keep building on this. We're going to take this idea of measuring spread and apply it to the entire stock market, all at once. So normally we use standard deviation to measure volatility, right? How much a single stock's price bounces around over, say, a month or a year. But what happens if we just flip that on its head? What if we take a snapshot of the entire market and measure how differently all the stocks performed on just one single day? And that question leads us straight to the core idea we're talking about today, cross-sectional dispersion. It's a snapshot. It's not about one stock's journey through time. It's about the sheer variety of returns across the whole market at one specific moment. Okay, let's make this crystal clear. When we talk about a single stock, standard deviation is its volatility over time. One stock, many days. Cross-sectional dispersion, though, is about diversity. Many stocks, one day. That's the crucial distinction. One is a journey, the other is a group photo. All right, so why do we even care about this? Why does this market diversity matter? Well, for active fund managers, the professional stock pickers, dispersion is everything. It's basically the field they play on. This quote just hits the nail on the head. An active manager's whole job is to find the winners and avoid the losers. So, by definition, they're making a bet on dispersion. They're betting that stocks will actually perform differently from each other. So what creates this perfect environment for a stock picker? It really comes down to two key ingredients. First, you need individual stocks to be volatile. They have to be making big moves up or down. But second, and this part is absolutely critical, they can't all be moving in the same direction. High volatility plus low correlation, that's the magic recipe for high dispersion. And here's the payoff. When dispersion is high, you get these clear winners and clear losers. That creates a huge opportunity for a skilled manager to beat the market. But when dispersion is low, all the stocks are moving together like a herd. It becomes almost impossible to stand out because every stock is performing just like the average. In that kind of market, there's just nowhere for a stock picker to hide or to shine. So this whole dynamic leads us straight to a pretty sophisticated strategy that Wall Street uses to trade this exact idea. It's called the dispersion trade. The trade is built on a really simple, almost intuitive belief. The individual stocks inside an index will always be more chaotic and volatile than the smoothed-out index itself. You're betting on the noise of the individual parts against the relative calm of the whole. At its heart, it's a bet that correlation is never perfect. So here's the simple version of how it works. A trader sells options on an entire index, like the S&P 500. That's a bet that the index as a whole is going to be pretty calm. At the exact same time, they buy options on a bunch of the individual stocks in that index, betting that those individual companies will be all over the place. So they're shorting the pack's volatility and going long on the individual players' volatility. Now, that might sound like a pretty clever hedged strategy that makes money no matter what. But, and this is a massive, massive but, there is a huge catch. This quote from Quantpedia is brutally honest. This is not a safe bet. It's what's known as a fat tail strategy. What that means is most of the time it might grind out small profits, but it carries the risk of rare, sudden, and catastrophic losses, especially when the market starts to panic. To put some hard numbers on that risk, just look at the Sharpe ratio from a sample strategy. The Sharpe ratio basically measures how much return you get for the risk you're taking. A negative number is just terrible. It means the strategy's returns didn't even come close to compensating for the risk involved. And if that didn't scare you, this will. A maximum drawdown of 55%. Let that sink in for a second. At its lowest point, this strategy had lost more than half of its value. That is that fat tail risk we were just talking about, showing up in the most painful way possible. So how does it all go so wrong? Well, that core belief the entire trade is built on, that stocks won't all move perfectly together, gets thrown right out the window during a crash. In a panic, correlation spikes towards 1. Everyone sells everything. Diversification just fails, and every single stock plummets in lockstep. The bet doesn't just lose, it blows up spectacularly. And that leaves us with the central dilemma of this whole powerful concept. Dispersion creates a really clear opportunity for skilled investors to get an edge when markets are calm, but the very strategies built to capture that edge carry this insane risk of catastrophic failure precisely when markets are at their most chaotic. It's the ultimate Wall Street trade-off, the hunt for a steady edge versus the risk of a sudden, spectacular collapse.